Fed has never solved any of our problems. It's simply made them worse. The only tools it has is inflation. That's what they've done. So every time there's been an economic problem, the Fed has created inflation. Now, they called inflation, quantitative easing, reducing interest rates, but it all amounted to expanding the money supply, the credit supply. They inflated. And in so doing, they bought time. They allowed us to kick the can down the road and allowed the problems to get worse in the process.
Peter Schiff, the chief global strategist at Euro-Pacific Asset Management, is cautioning investors about their excessive complacency regarding Federal Reserve policy, inflation, and the outlook for the stock market. This is in contrast to the prevailing belief that the inflation genie is under control, and the Fed has successfully managed a smooth economic transition. Schiff is warning of an impending inflationary depression, despite the Federal Reserve policymaker awaiting further evidence of easing price pressure before considering interest rate cuts. A recent government report suggests that consumer inflation remained elevated last month. Despite this, the Fed maintained its policy rate within the 5.25% to 5.5% rate since last July. Fed Chairman Jerome Powell, while acknowledging some progress, cautioned that the upcoming March meeting might still be premature to declare victory in the battle against inflation. In response to the inflation data, U.S. Treasury Secretary Janet Yellen noted that the recent consumer price inflation figures slightly exceeded expectations. However, she urged Americans to focus on longer-term decline in inflation trends. The strength of economy and rising wages. Schiff argues that there is a prevailing belief in the quick return of the Federal Reserve to rate-cutting tactics, leading to an ongoing market surge sustained by quantitative easing and near-zero interest rates since 2009. Despite this belief, Schiff contends that this trajectory may not be sustainable, putting the United States at greater risk of a fiscal crisis. The high that could limit policymakers' flexibility to deal with unexpected events, making recovery more challenging if the country faces another major recession like 2007 to 2009. With the national debt rapidly rising to $34 trillion, Schiff sounded the alarm on an imminent fiscal crisis, asserting that despite official data indicating otherwise, the country is likely already entrenched in a recession. Prior to delving into the video for more profound insights, he urged viewers to subscribe to the channel and enable notification for timely updates on the news content.
Well, they're missing quite a bit, but I think that the biggest mistake that they're making is believing that, the inflation genie is back in the bottle, that the Fed's policies worked, that they pulled off the soft landing. In fact, we didn't even land. We avoided recession entirely. Everything is great, and now the Fed can start cutting rates again, and the markets can just resume this huge run that they've been on, really ever since 2009, when the Fed started the policy of quantitative easing and 0% interest rates. And it seems that the markets think that this can continue indefinitely, but it can't. The Fed has not succeeded in putting the inflation genie back in the bottle, not even close. Yes, we did come down from 9% year-over-year inflation to, a bit over 3%, but that's probably about as low as it's going to go. I think inflation has bottomed and it's headed back up, and we're headed back towards 9. In fact, we're going to go higher than 9. And we have a fiscal time bomb that's going to go off sometime soon as the national debt is rising by nearly $1 trillion a quarter. I think that we're probably already in recession. I think the idea that we've avoided one is absurd. I think the government numbers don't tell the whole story, and I think they're likely to be downwardly revised, 6 months, a year from now. That's what they did with the Great Recession, which started in December of 2007, but they didn't acknowledge it until December of 2008. The government went back and revised down a year's worth of rosy economic data and then said, we've been in a recession the entire time. And it's quite possible that that's going to happen this time. In fact, that's probably why Biden is the most unpopular president in history, it's because the economy is in recession, and the statistics just don't bear that out, but the polls do, because the voters are expressing their frustration at the economy. And so I think what's going to happen is we're not going to get as many rate cuts as the markets are hoping for, because inflation is going to turn north, but the Fed is going to return to quantitative easing, which I think is an even bigger pivot than rate cuts, because I think the alternative is too big a disaster for the Fed to allow, because it would mean a worse financial crisis than 2008, and I think it would mean the U.S. government would be unable to service its debts, and so in order to prevent a default or dramatic cuts to government spending to avoid default, I think the Fed is going to monetize the debts. I think we're going to go back to quantitative easing and abandon quantitative tightening. And I think that's going to collapse the dollar. I think it's going to send gold commodity prices through the roof, and it's going to be a big problem.
In the ongoing inflation debate, Peter Schiff contends that inflation is a result of expansion of the money supply, rather than being directly linked to the economic growth. Currently, the USM2 money supply is at 2.87 trillion, a slight increase from the previous month's 2.77 trillion. Despite showing sign of a slight decrease from the peak of 99.1% in June 2022, recent data indicates the downward trend in high inflation impacting household budgets and the economy since mid-2021 remains unstable. Schiff expresses concern about the Federal Reserve's continued money printing, exacerbating worries over the years dating back to 1933. He notes that the purchasing power of the US dollar has domestically declined by 92%. Schiff asserts the conventional media has largely overlooked the Federal Reserve's role in creating an impending economic disaster. He argues that the mainstream media often portrays Fed chairmen as economic savior, with their mistakes going unrecognized. Now let's redirect our attention to a video for further insights.
Inflation is about money. It's a monetary phenomenon. It's got nothing to do with economic growth. It's the growth of the money supply. That's what inflation is. And when you have more money, prices are higher than when you have less money. When the economy grows, a real economic growth produces more goods and services, and that helps keep prices down. That can offset the impact that inflation has on pushing prices up. So it's really a strong economy that helps keep prices down, not the reverse. When you have a weak economy, if factories are producing fewer goods, if workers are providing fewer services, then prices will go up. And what really stokes inflation in a weak economy is not only do you have fewer goods and services being provided, but you have more money being printed, because unemployed people get government benefits. They get, welfare payments or food stamps or stimulus checks. And so the government tends to print even more money and run even larger deficits when the economy is weak than it does when it's stronger. And that is an inflationary force. So we have more money printing and less goods production. And so I think this next recession is really going to fuel the inflation fire, because it's going to start when the inflation is already elevated. And I think when the dollar really starts to tank, which I believe it will, that's going to dramatically accelerate the upward pressure on prices. There is going to be a point, and we're probably very close to that point, and I don't know if we're going to be there by my talk in April. We'll see. But there's going to be a point where the Fed can't do that, and that is the end game. That's where the truth is laid bare, and we see the inevitable consequences, where we have the collapse of the dollar, runaway inflation, and then there's nothing the Fed can do, because all of its tools are inflation. And so if we have a dollar crisis and a sovereign debt crisis, and we have a banking crisis and the economy is in depression, is collapsing, what can the Fed do? What they did in the past that we thought worked won't work. It'll just make it worse. They can't add fuel to the fire by printing even more money when the problem is we got too much money. The problem is a loss of confidence in the dollar, and you don't instill confidence by creating even more. And so this is going to expose decades of failed policy, of monetary policy mistakes that I've been one of the lone voices to publicly criticize. But the conventional media has rallied around the Fed and extolled the Fed chairmen as saviors of the economy, and they've done no wrong, but they are actually the architects of this coming disaster.
Some investors, however, hold the belief that stocks are currently better positioned to withstand another climb in yields. One key factor behind this perspective is the resilience demonstrated by the US economy, which has proven to be more robust than anticipated in the face of higher interest rates. This has softened concern about whether tighter monetary policy will negatively impact growth, despite investors adjusting their expectation to the extent to which the Federal Reserve will cut borrowing costs. Many still believe that, given the persistent inflation, US central bank policymakers are likely to lower rates later this year. The statement wraps up by inviting listeners to share their insights in the comment section, encouraging those who found the content beneficial to give it a thumbs up, and urging viewers to subscribe for regular updates. The audience is appreciated for being part of the journey.